Okay, see, last exemption 54F. This exemption is available if you are individual or HUF. You have transferred any capital asset. Any means any capital. It can be shares, jewelry, it can be any capital asset. Okay. So any capital asset other than residential house property. Okay. But as on the date of transfer of this capital asset, no? As on the date of transfer of this capital asset, the assessee should not own more than one house property, one residential house property. So it is a condition to claim the exemption, that if you want to claim the exemption, then the date on which you are transferring your original asset, as on that day, you should not own more than one residential house property. If you don't have any house property, no problem, you can claim the exemption. If you have one house property, no problem, you can claim the exemption. But if you have more than one house properties, you cannot claim this exemption. Okay. Now this capital asset you are transferring, it can be any capital asset. The long-term capital gain arising on this capital asset will be exempt. Under section 54F. Now usually what we used to see in the earlier 5 sections which we have done, okay, earlier 4 sections, that capital gain is invested. So whatever cost is met, whatever investment is done, that is out of capital gain. But in this section, the assumption will be what? That the investment is not made out of capital gain, investment is made out of net consideration. So if the amount of investment is equal to net consideration, or the amount of investment is more than net consideration, then the entire capital gain will be exempt. Meaning the exemption will be available in proportion to the investment out of net consideration. Understanding? So exemption under section 54F, either full LTCG is exempt or proportionate LTCG is exempt. When full will be exempt? If the investment amount, investment means cost of new asset, is more than or equal to what? Net consideration. Or if the investment, meaning the cost, if that is less than net consideration, then you'll have to see the proportion, that how much of the net consideration is invested. For example, net consideration is 100 and investment is 80. So how much consideration is invested? 80%. So 80% of the gain will be exempt. If the net consideration is 100 and investment is 60, meaning 60% is invested, so 60% gain will be exempt in proportion to the investment. Here net consideration was 100 and investment is 100, meaning full net consideration invested, full capital gain exempt. Net consideration was 100, investment is 120, meaning full net consideration invested, full capital gain exempted. Will you remember this? Yes or no? Now how much proportionate gain will be exempt? It will be in the proportion, and for that you will have to follow a formula. What formula? LTCG, apply this proportion. What proportion? Investment, meaning the cost of new asset divided by net consideration. That's it. Investment divided by net consideration, this is the proportion. That proportion you apply to the gain. To that extent you will get the exemption. Understood or not? Tell me. But investment has to happen in a new residential house property. So first of all, you transfer any capital asset and invest the net consideration of that capital asset in a new residential house property. New residential house property. Either purchase or construct. Purchase within 1 year backward, 2 years forward. Construction within 3 years forward. And CGD option is also available as it was available in the first case. Yes or no? So you have to purchase what? Any one residential house property in India within 1 year backward, 2 years forward. You have to construct what? Any one residential house property in India within 3 years forward. Yes or no? So whatever property is purchased or whatever property is constructed within this time, it will be assumed as if it is purchased, as if it is constructed out of the net consideration of your asset transferred. So what was the asset transferred? For example, shares were transferred. Which asset is transferred? Any capital asset. For example, you have transferred the shares. So out of the net consideration of the shares, you are supposed to purchase, or you are supposed to construct, or you are supposed to invest in CGD account. Getting my point? Then whatever investment is happening, based on that investment, you are going to get the exemption of this gain. Either this gain will be fully exempt or this gain will be proportionately exempt. Will you remember this? Sure. So now, for example, and see, investment in a new residential house property. That amount of investment over and about 10 crores will be ignored. And there was a option given in section 54. If you remember, you can invest in 2 properties and claim the exemption. That option is not available for 54F. Even if your capital gain is up to 2 crores, investment has to be made in only 1 property. Understanding? So now pay attention. But that restriction of 10 crores investment in new residential property is applicable for 54F also. Yes or no? So now say, for example, you have some shares, or you can have jewelry also. You can have any capital asset other than residential property. So you have to transfer any capital asset other than residential property. So what are you transferring? Shares. By transferring the shares, will you get long-term capital gain? Yes or no? That long-term gain will be exempt under section 54F. Now to claim this exemption under section 54F, by selling the shares, you might have received net consideration. This net consideration you have to invest. Invest in purchase, construction or CGD account. Yes or no? Purchase, construction of residential property or deposit in CGD, so that out of that amount you can later on purchase or construct. Done, sir? Now the date of transfer. What did I say? The date of transfer of shares. As on this date, assessee should own 1 or less residential house property. So the date on which you are transferring the shares, as on that date, you should have no house property or you should have maximum 1 house property. Then the gain of the shares will be exempted, provided you invest in new residential property. Got it? So now, for example, the long-term gain was 6 lakhs. How much? And the net consideration was 10 lakhs. So if net consideration is 10 lakh and long-term gain is 6 lakhs. So you have to invest in new residential property. You have to buy or you have to construct. Now you will have to see that the cost of the new residential property purchased is 12 lakhs. So how much investment happened? 12 lakh. The 12 lakh is happening out of gain or it is happening out of net consideration? Out of net consideration. So tell me, how much is the investment? Can I say entire 10 lakh got invested? So entire capital gain will be exempted. Understanding? Tell me, if the investment was 10 lakhs, new residential property purchased for 10 lakhs, new residential property constructed for 10 lakhs, CGD 10 lakhs, then entire net consideration invested, entire capital gain exempted. 6 lakh will be exempt. Understanding? For example, investment is only 7 lakhs. Investment is entire net consideration invested. Proportionate, no? 7 lakh divided by 10 lakhs. 7 by 10. to that extent only your capital gain will also be exempt. So how much will be the exemption? 70%. Because 70% of the net consideration is invested, 70% of the gain will be exempted. Out of this net consideration, 7 lakh invested, meaning 70% invested, no? So out of this also 70% will be exempted. How will you calculate? 6 lakh into 7 divided by 10. 7 divided by 10 is 70%. 70% of 6 lakh. Yes or no? So how much will be the exemption? 4 lakh 20. Full capital gain exempt or proportionate? And balance is 1 lakh 80. That will be taxable. Will you remember this? Sure. Now tell me one thing. You have to invest in purchase or construction. What if you invest in the purchase or construction on or before the due date of filing your ROI? Then based on that investment, you will get 54F exemption. But what if you are not able to purchase or construct on or before the due date of filing ROI? Can you deposit in CGD? Yes or no? So for example, you had some jewelry. Okay. Jewelry was a long-term capital asset. So this jewelry was what? Transferred. Okay. Now the net consideration of this jewelry was 25 lakhs. Sorry, 20 lakhs. How much? 20 lakhs. And the long-term capital gain on this jewelry was 12 lakh rupees. How much was the long-term gain? 12 lakh. Possible, not possible? Now, this net consideration has to be invested in purchase or construction. So, if the purchase or construction of the new residential property is happening within on or before the due date, then there is no problem. But what if the due date has come and you have not yet purchased or constructed a property then? And you want to claim the exemption. Can you deposit the amount in CGD? So, you deposit the amount in CGD. Now, whatever amount you are going to deposit in CGD, your gain you are not depositing, you are depositing your net consideration. So, out of your net consideration, how much amount is deposited in CGD? For example, 18 lakhs. So, can I say this is an investment out of your net consideration? How much? Full net consideration invested? Or only 90%? 18 lakh divided by 20 lakh is 90% only, no? So capital gain will be fully exempt or only 90%. So how much exemption you are going to get? Now please remember, please remember, this is very important thing I am telling you, that if you invest in CGD, the amount invested in CGD is not exempt. If you invest 18 lakh, this 18 lakh is not exempt. Against this 18 lakh, 10 lakh 80 was exempted. So you deposit in CGD, how much? 18 lakh. Exemption is not 18 lakh. Exemption was 10 lakh 80. Okay, no? Now, you have to make sure that the amount you deposited in CGD, you have to use that in purchase or construction. Then the amount is utilized. But what if you withdraw that amount? Out of 18 lakh, you are withdrawing something and you are misutilizing. What we used to do? The amount of misutilization, the amount which is misutilized, that entire amount we used to consider as deemed long-term gain. Yes or no? Here you cannot do it. If you will do it like that, the answer will be wrong. How much you have deposited? Tell me. Now out of this 18 lakhs, out of this 18 lakh, amount misutilized was, example, 4 lakh rupees. So you have withdrawn how much? 4 lakh. And did you use this 4 lakh for purchase or construction of another residential property? No. So this 4 lakh is misutilized. If we were in other sections now, what we would have done? This 4 lakhs we would have considered as deemed LTCG. Yes or no? Now you cannot consider this 4 lakh as deemed LTCG. Why? Because this 4 lakh is out of that amount which was not exempt. If you invested this much, so exemption was this much. So out of this, if you have misutilized, then against this, how much exemption was there? That you have to calculate by doing cross multiplication. Getting my point? So against 18 lakh, the exemption was 10 lakh 80. So out of that 18 lakh, if 4 lakh is misutilized, against this 4 lakh, how much was exempted? That you calculate. How much? How much? 2 lakh. This will be your deemed LTCG. In the year in which you will misutilize 4 lakhs, in that year, 4 lakhs? No. 2,40,000 will be deemed as long-term capital gain. Yes or no? Now, you have utilized 12 lakhs. So how much you deposited? 18 lakhs. Out of that you withdraw 12 lakh and you use it for purchase or construction. Meaning that is the amount of utilization. Any exemption against this amount will be still there with you. That will not be revoked. That will not be your deemed LTCG. Yes or no? Because out of 18 lakh you are utilizing this 12 lakh for purchase or construction. So any amount against this which was exempt will still remain exempt. So how much? Against 18 lakh exemption was this much. So against 12 lakh, how much will be the exemption? How much? 3 lakh? 3 lakh 60. Huh? Against 18 lakhs, if the exemption was this much, so out of this 18 lakh, again 12 lakh is utilized, no? So against this 12 lakh, how much is the exemption? Cross multiplication. Simple. 7 lakh 20. How will you do 10 lakh 80 into 12 divided by 18? 18 lakh was deposited. That time, how much was exempted? 10 lakh 80. So from that 18 lakh, if 12 lakh is utilized, so against this 12 lakh, how much is the amount still exempt? 7 lakh 20. That 7 lakh 20 exemption again you are not going to get. This exemption will remain with you. This exemption will remain with you under section 54F. Because this is the exemption against the investment in the purchase or construction. Now tell me, 3 years will expire. How many years? And on the expiry of 3 years, will you have any balance in CDD account? How much amount you invested? Out of this misutilized how much? Utilized how much? And 3 years expired. So your CDD account will still show unutilized balance. How much? What we used to do, that entire unutilized amount was deemed LTC. You cannot do it here. Now out of 8 lakh unutilized balance was how much? 2 lakhs. So against this, how much was the exemption? 1 lakh 20,000. Now this will be your deemed LTCG on the expiry of 3 years. So on the expiry of 3 years, in your CGD account, if still 2 lakh rupees is remaining, that 2 lakh will not be deemed LTCG. Against that 2 lakh, 1 lakh 20, which we exempted, no, will be treated as deemed LTCG. Understanding? So how much is still exempt? See, first you invested 18 lakhs. Then you got the exemption of 10 lakh 80. So 10 lakh 80 was exempted. But out of that 10 lakh 80, 2 lakh 40 will be deemed LTCG because that 2 lakh 40 is against the amount of 4 lakh which you have withdrawn from 18 lakh and misutilized. On the expiry of 3 years, out of this 10 lakh 80 which we exempted, no, out of this 10 lakh 80, 1 lakh 20 will be deemed LTCG. In the year in which the period of 3 years expires, because in that year 2 lakh is still unutilized in your CGD balance. And out of this 10 lakh 80 which we exempted under section 54F, 7 lakh 20 exemption will still be there with you. Okay, because that is an exemption against the 12 lakhs which you have withdrawn out of 18 lakh and utilized for purchase or construction of another residential property, and this will remain with you. This will remain with you. But wait, Utilized means purchased or construction, meaning this 12 lakh is the cost of new property which you have purchased out of your CGD account. And if this property you sell within 3 years, this 7,20,000 will also be revoked. You don't have to sell that property which you purchased for 12 lakhs. You don't have to sell that property which you constructed for 12 lakhs. So by withdrawing the amount out of CGD, you purchased a new property for 12 lakhs. By withdrawing the amount from CGD, you constructed a property for 12 lakhs. Against that, 7,20,000 exemption will still remain with you. But remember that new property which you have purchased or constructed for how much? 12 lakh, yes or no? If you sell that property, if you transfer that property within the lock-in period of 3 years, then this 7,20,000 will also be revoked. And how it will be revoked? Simple. It will be treated as your deemed LTCG in the year in which you have sold the new property. It is not to be reduced out of the cost. It is not to be reduced out of the cost as you used to do. And this can be revoked once more. This can be revoked in other case also. If other than this property, any other property is purchased. If other than this property, any other property is constructed within the period of 2 years or 3 years. So for example, you sold your jewelry. You sold your jewelry. What was the net consideration? 20 lakhs. What was the net consideration? 20 lakhs. What was the capital gain? 12 lakhs. Now to claim the exemption, what you did? You invested in a new property. You invested in a new property. What was the cost of that new property? 12 lakhs. What was the cost of that new property? 12 lakhs. Against that, how much exemption you got? 7,20,000. So, if you sold your jewelry, net consideration was 20 lakhs. Hello. And your capital gain was 12 lakhs. So you invested in the purchase or construction of a new property. How much investment? 12 lakhs. So from this capital gain, how much is exempt? 7,20,000. Yes or no? If you sell this property within 3 years, then this will be revoked. Not just this. Any other property other than this property, any other property you purchased within the period of 2 years, or any other property you constructed other than this, any other property you have constructed within 3 years from the date of transfer of original asset, then also this will be revoked. So this property you cannot transfer within 3 years. And other than this property, any other property also purchased, any other property constructed within 2 years or 3 years, then also this will be revoked. And how the revocation will happen? This entire 7.2 lakh which was exempted under section 54F will be deemed to be your long-term capital gain in the year in which this property will be sold, or in the year in which you will purchase any other property except this one, yes or no, or in the year in which you will construct the other property except this one. But if that purchase or construction of other property is happening within 2 years or 3 years from the date of transfer of your jewelry. So from the date of transfer of your jewelry, within 2 years, within 3 years, make this property, no problem, we'll give the exemption. But if along with this property, one more property purchased, then this exemption will be taken back. Along with this property, if any other property is constructed within 3 years, then this exemption will be taken back. And see, you cannot transfer this property also within 3 years. Then also this will be taken back. Understood? 54F over. Will you remember this? Sure, sir. All the exemptions are done. Okay. Now, whatever balance questions are there, those balance questions we are going to solve. But wait. Before that, we'll complete the tax rates. And once we'll complete the tax rates, whatever remaining questions are there, that we are going to solve. Okay, no? Pay attention. Do you remember the tax rates? What is the tax rates on short-term gain? Normal rates or 111A? Do you remember? So, for example, you are having short-term capital gain on what? On transfer of. Now, what are you transferring? You are transferring listed equity shares or units of equity oriented mutual fund, or you are transferring units of business trust. And transfer of these assets, these three assets, is happening on recognized stock exchange on or after 1st of October 2004, and on transfer STT is also paid. Then whatever short-term gain will come will be covered under section 111A and will be taxable at 20%. Do you remember that? Yes or no? Transfer of any other capital asset, then the short-term capital gain will be covered under section 111A. The answer is no. That is your normal income and taxable at what rate? Taxable at normal rates or 115 BSE rates. Yes or no? As the case may be. Will you remember this? I've already told you this. Sure, no? Now pay attention. Pay attention, everyone. This short-term capital gain is there, no? Under section 111. This will arise if you transfer the shares on recognized stock exchange. And STT must also be paid. So two conditions are very important. The transfer should be made on stock exchange. And also the STT must be paid at the time of transfer. It may or may not be paid at the time of acquisition. That is not a problem. But the STT must be paid at the time of transfer. What if STT is not paid? Then the gain will not be covered here. Gain will be covered in normal rates. Yes or no? But wait. Have you heard about IFSC? What is IFSC? That bank code, IFSC code, yes or no? No, I am not talking about that. I am not talking about that bank code. IFSC full form is International Financial Services Center. What? It is a location. What is this? IFSC is a specified location, geographical location. Yes or no? In this location, no, this is a notified, just like special economic zones are there, you know, SEZs. SEZ is a specified location. You come and do your business, start your manufacturing business here, or start your business of providing services from here, which you will export. So the government will give you many benefits if you locate in SEZ. So just like that, there is International Financial Services Center. Okay. It is a geographical location. In this location, if the assessee is having a unit, a business unit in IFSC, so what is the main business of those assessees who will set up their business units in IFSC? They are providing financial services. Which services? All the services related to finance field. Big broker houses, big mutual fund, banks, this, that, all the financial service providers will be located at this location. And what they are doing, they are providing their financial services outside India, meaning the financial services are being exported from this location. So since you all are scattered all across India now, so the government is not able to focus on each one of you, why don't you all come and gather at one place? Start doing your business from this location. Start providing your financial services outside India from this location. So the government will have an eye on you and the government will be able to provide you proper benefits, proper facilities to do your business. Ease of business will be there, yes or no? Because government wants your business to flourish. Why? Because you are in the business of providing financial services outside India. You are going to earn huge foreign currencies for Indian economy. So you all are very important for India, economy of India. Yes or no? So if you are scattered all across India, no, so government is not able to reach to all of you. So government is calling you, why don't you all gather at one place and start doing your business from this location itself? And that location is known as what? International Financial Services Center. How many IFSCs are there in India, you know? Only one. And that too also in Gujarat. It is around 150, 200 kilometers from my house. Okay. You might have heard about a place known as Gandhinagar, capital of Gujarat. Ahmedabad, Gandhinagar. Ahmedabad, Gandhinagar. So there is a highway. Ahmedabad, Gandhinagar highway. So on that highway, when you reach Gandhinagar, no, capital city of Gujarat, just before Gandhinagar, a huge area is notified as IFSC. And the name of that area is Gift City. We call that area Gift City. Why that name, you know? Gujarat International Financial Tech City. Gift City. Gujarat International Financial Tech City. Hence the name is Gift City. And that Gift City is what? IFSC. International Financial Services. You will see the business houses doing businesses from that location, no? All are engaged in providing financial services. And they provide their financial services. Services relating to brokerage houses are there, then banking services, then insurance services, yes or no? Big financial services providers are there. And they are providing their services to Indian customers. No, outside India. And they are bringing valuable foreign currency in India. And in this IFSC, no, which is a specified location, there is a recognized stock exchange in this IFSC also. Just like NSE and BSE is there, no? There is one more stock exchange in IFSC. Now, on this stock exchange, shares and securities of the global companies are traded. If you want to buy the shares of Apple, you can buy on this stock exchange because the shares of Apple are listed on this stock exchange. If you want to buy the shares of Facebook, Meta, yes or no? Oracle, Microsoft, big brands, international global giants, you can see the shares and securities of those companies also listed here. And this is a stock exchange which is set up in IFSC, and this stock exchange competes directly with international stock exchanges like New York Stock Exchange, London Stock Exchange, yes or no, Luxembourg Stock Exchange. These are the international, Singapore Stock Exchange, all those stock exchanges. There also you will see the shares of different global companies which are being traded. Just like that, here also, this is a stock exchange. Here, the traders fall all across the globe. We trade in the shares of global companies. And the trading will happen in foreign currency. Indian currency, no. All the trading will happen in foreign currency. And on this stock exchange, the transactions of buying and selling happen in foreign currency, meaning all the transactions of buying and selling in which currency? In foreign currency. And to attract the international traders to come and trade on this stock exchange, the transaction cost should be reduced. Hence, on this stock exchange, whatever the transactions of buying and selling are there, on that STT is not charged. No STT. Because STT will be charged, what will happen? Because of that, transaction cost will increase. And since the transaction cost will increase, the international investors, international traders will not show their interest in trading on this stock exchange. So why to buy the shares of Apple on this stock exchange if the transaction cost is higher? Let me buy on New York Stock Exchange. So an international trader or international investor, he will definitely prefer other stock exchanges over this stock exchange. because the transaction cost is higher. Why? Because of STT. So let us remove STT. We will not charge any STT on buying and selling transaction, so that the transaction cost becomes less and the traders are attracted, investors are attracted in buying and selling on this stock exchange. So to promote the trading on this stock exchange, this STT exemption is given. Now tell me, if you are having any listed equity shares which you are buying and selling on this stock exchange, STT is charged on transfer or not charged? Will that gain be covered by 111A or will not be covered? Still it will be covered under 111A. This is an exception. So even if on this stock exchange the listed equity shares are transferred or the shared units are transferred, yes or no? And even if no STT is charged, still that short-term gain will be covered by 111A. Will you remember this? Short-term gain tax rates over. Now you also know the long-term gain tax rates. Tell me, long-term capital gain on what? Transfer of what? Listed equity shares, units of equity oriented mutual fund, units of business trust. Okay, so these are transferred on recognized stock exchange on or after 1st of April 2018. Prior to this, the long-term gain arising was fully exempt under 1038, if you remember. I have already told you. But on or after 1st April 2018, if these assets are transferred and the gain arising, that gain will now be not exempt. That gain will be covered by a special section 112A. So I'm talking about the long-term gain which is covered by 112A. Which long-term gain will be covered? Long-term gain arising on transfer of any of these three assets. If these assets are transferred on recognized stock exchange on or after 1st April 2018 and on transfer, STT must be paid, and on acquisition also STT must be paid, but this is a requirement only in the case of listed equity shares. So in the case of listed equity shares, the STT must be paid at the time of acquisition also, and STT must be paid at the time of transfer also. In the case of units, STT may or may not be paid on acquisition, but STT must be paid at the time of transfer. Understanding? Yes or no? Now, on this transfer, whatever gain will come, long-term gain will be covered under section 112A up to 1.25 lakhs. Taxable or not taxable? No tax, no tax. See, the gain is taxable, but at the time of paying the tax, don't pay any tax on this 1,25,000. So entire gain you are supposed to calculate and you have to show in the computation of total income. But when you calculate the tax, don't calculate the tax on first 1,25,000. No tax on first 1,25,000. This is just like a basic exemption limit given for this long-term gain. Understanding or not? So during the previous year, the aggregate long-term gain. During the previous year, your aggregate long-term gain, which is covered by 112A. Yes or no? Up to 1,25,000. On that, no need to pay any tax. Tax will be 0. And on the excess, how much? 12.5%. Yes or no? Now, if the above transaction is happening on a stock exchange in IFSC, where STT is not charged, then the long-term gain arising on transfer of these assets on this stock exchange, even if the STT is not paid, will still be covered by 112A. Even if STT is not charged, the benefit of 112A will be available for this long-term gain also, which is arising on transferring the assets, transferring these three assets on the recognized stock exchange in STT. Sorry, IFSC. Understood or not? Yes or no? Done. Now long-term gain on transfer of. Hey, wait. When you calculate this long-term gain, do you remember cost of acquisition of these assets will be actual cost. But the cost of acquisition can be 55 to AC also, if you remember. So whenever you will calculate this gain, if the assets, these three assets are purchased prior to 1st February 18, then actual cost you are not going to take, you are supposed to determine the cost as per 55 to AC. And what if any of these three assets are purchased on or after 1st February 18? Then don't apply 55 to AC. Take the actual cost and calculate your gain. Hello? This thing we have already seen, huh? 2 questions. And both the questions I have told you to mark important. Test your knowledge. Question number 1 and if I am not wrong, question number 8. Both the questions are having long-term gain under section 112A. Yes or no? Next one. Now, if the long-term capital gain is arising on transfer of any other capital assets, so it will be covered by which section? 112. Taxable at what rate? 12.5%. And this will be without indexation. No indexation will be available to calculate your long-term gain under 112A also and 112 also. So without indexation, calculate all the gains, long-term gains. The long-term gain which will be covered by 112 will be taxable at 12.5%. But do you know, here one option is also given. Long-term gain on jewelry. Tell me, long-term gain on jewelry will be covered by 112. Will be covered by, at what rate? 12.5%. Without indexation, calculate the gain, pay tax at the rate of 12.5%. Yes or no? But if you are an individual, you are a resident, and the long-term gain is arising, then 12.5% or 20% with indexation, whichever is lower. Don't do that, I will give you a slap. For jewelry, this is not applicable. It is applicable only in the case of immovable property. So there is one exception to calculate the tax here. What exception? In the case of resident, individual or HUF, the long-term gain arising under section, long-term gain arising on transfer of immovable property. That immovable property which was purchased prior to 23rd July 2024 and which was transferred on or after 23rd July 2024. The long-term gain will be calculated without indexation. On that 12.5% tax you have to pay. But you have to recompute that gain by taking the indexation, and on that you can pay 20% tax also. Pay the tax whichever is more beneficial. But this is applicable only in this case. All the long-term gain in all the other cases calculated without indexation, and the tax will always be 12.5%. Will you remember this? Yes or no? And the last point I am going to tell you now, common points. What did I say? Common points. Now these common points are applicable for 111A also, 112A also and 112 also. So the short-term capital gain covered by 111A, long-term capital gain covered by 112A and long-term capital gain covered by 112. So whatever points I am going to discuss now, these points are common. These points are common for all these gains. Yes or no? Number one. No chapter 6A deductions, meaning deductions from ATC to ATU will not be available. Can you claim chapter 6A deduction out of these gains? Sure. Number 2, chapter 6A deduction you can claim from all the incomes in your GTI. But in your GTI, if these 3 incomes are there, separate these incomes from these incomes. Chapter 6A deductions are not available. You have to show these incomes fully in your total income without claiming any chapter 6A deduction out of these incomes. Yes or no? Number 2, higher rate of surcharge at the rate of 25% or 37%. In the case of assessee shifting out. Yes or no? And if the assessee is not shifting out, higher rate is 25% only. Yes or no? That higher rate of surcharge not applicable on what? On tax. Tax which you have calculated on what? STCG 111A, LTCG 112A, LTCG 112, and one more income, dividend income. So the tax which you are going to calculate on these four incomes, on those taxes, the maximum surcharge rate will be 15%. Even if your total income is more than 2 crore, more than 5 crore, that surcharge on balance income tax can be at the rate of 25%, 37% as the case may be, but the maximum rate of surcharge on these taxes will be 15%. The higher rate of surcharge is not applicable for these taxes. Yes or no? Hello? Third point. No rebate. No rebate of taxes computed on special incomes. And what are the special incomes? Special incomes. What are the special incomes? These incomes are special incomes. Yes or no? Then winnings can also be there. Taxable under section 115 BB or 115 BBJ. Okay. And unexplained incomes can also be there. Taxable under section 115 BBE. So these are the special incomes which are taxable at special rates. So whatever tax which you have calculated on these incomes cannot be claimed as rebate. So before claiming rebate, separate these taxes. These taxes you have to pay fully. Balance taxes only you can claim as rebate up to 12,500 or 60,000 as the case may be. If you are in the default tax regime, then up to 60,000. And if you are in optional tax regime, then up to 12,500. Yes or no? So only the balance taxes can be claimed as rebate. These taxes on these special incomes cannot be claimed in the form of rebate. These taxes fully you will have to pay. Understanding? On these taxes, higher rate of surcharge is also not applicable, and these taxes cannot be claimed as rebate. Understanding? Sure, sir. And now the last and most important point. Adjustment of unexhausted basic exemption limit is allowed from STCG 111A, LTCG 112A and LTCG 112 only. Adjustment of what, guys? Adjustment of unexhausted basic exemption limit is allowed from this income and this income. Now for example, I am telling you, your total income was 4,90,000. How much? Assuming that you are not following 115 BSE, you are shifting out. Yes or no? So if you are not following 115 BSE, you are shifting out. So your total income was 4,90,000. In your total income, no, there was short-term capital gain under section 111A. And what is the amount of that short-term capital gain? It was 3 lakh rupees. How much, sir? Okay, so on this 3 lakh, you have to pay 20% tax. And what about the balance total income? Balance total income was 1,90,000. Yes or no? Tell me on this 1,90,000, are you going to pay any tax? Why? Because on this, normal rate of tax will be applicable. And when you will apply the normal rates are there in slabs. So in the slab rates, can you say basic exemption limit was 2,50,000 for you? Because you are covered by 115 BSE. But if, sorry, not covered by 115 BSE. If you are covered by 115 BSE, then I would have taken 4 lakhs. No, sir. So for example, your basic exemption limit is 2,50,000. Is your total income, balance total income, more than 2,50,000 or less than 2,50,000? Are you liable to pay any tax on that? But this year still you will have to pay tax. Because in your total income, this income is there. If this income was not there in your total income, no, you are not liable to pay any tax. So in this year, you are liable to pay tax because of this income, or LTCG 112 or LTCG 112A. So whatever discussion I am making right now, that is equally applicable for LTCG 112 also, LTCG 112A also. Yes or no? If this income was not there, bloody you were not liable to pay tax on your balance total income, because that was within the basic exemption limit. And see, if you see, no, your basic exemption limit is still unexhausted. Full 2,50,000 is not exhausted also. Till 60,000 rupees basic exemption limit is unexhausted. Even if you would have earned 60,000 more, still you are not liable to pay tax. Getting my point? So will it pinch you? Yes. That bloody my 2,50,000 basic exemption limit is there. I am earning only 1,90,000. Hello? Which is within my basic exemption limit. On that I am not supposed to pay tax. And if I would have earned 60,000 more also, then also I would not have been made liable to pay tax. But still I have to pay tax because my total income has short-term capital gain 111. So what they are giving you? They are giving you some benefit. They are saying that whatever unexhausted basic exemption limit is there, meaning to that extent also your income was not taxable. Yes or no? Do one thing. Adjust that unexhausted basic exemption limit from your short-term capital gain before calculating the tax on that. So how much was the unexhausted basic exemption limit? 60,000. Adjust it from here. How much is remaining? So don't pay tax on full 3 lakh. Pay tax only on 2,40,000. Because that benefit of that unexhausted basic exemption limit we are going to give you from STCG 111A, LTCG 112 and LTCG 112A. From all these 3 incomes you can take the benefit of unexhausted basic exemption limit. But it is available only for resident individuals or HUFs. So if you are a resident individual or HUF, only then you can do this adjustment. But this adjustment will be done only against 3 incomes. You cannot adjust it against winnings income. You cannot adjust it against unexplained incomes. You can adjust it only against 3 incomes. Number 1, short-term gain 111A. Number 2, long-term gain 112A. Long-term gain 112. From these 3 incomes only you can do this adjustment. But this adjustment will be available only if you are a resident individual or HUF. Will you remember this? So this is the end of your tax rates and the end of your chapter. Okay. Now only small 2-3 questions are remaining. Those we are going to complete and then we are going to start with the new chapter. Okay. Let's come to the questions first. Illustration number 11 we have done, no? Come to illustration number 12. Illustration number 12. Very good question. Should I start? See, they are saying that long-term capital gain of rupees 75 lakhs arising from transfer of a building. Can I say building is an immobile property? So by transferring an immobile property, how much is the long-term gain? See how good is your examiner. Examiner is not telling you to calculate the gain also. That poor examiner, that poor fellow has calculated the gain himself. He is saying that you have transferred a building, you have transferred an immobile property this year. And what is the long-term gain of that immobile property? 75 lakhs. And the building was transferred on 1st May 2025. So he has given the date of transfer of the immobile property. Because within 6 months from this date, you are supposed to invest in notified bonds. If you remember, yes or no? Within 6 months from the date of transfer of your immobile property. What is the date of transfer? 1st May 25. Okay, now see, long-term capital gain of 75 lakhs arising from transfer of building on 1st May 2025 will be exempt from tax if such capital gain is invested in bonds redeemable after 5 years issued by NHAI under section 54 EC. Examine with reasons whether the given statement is true or false having regard to the provisions of Income Tax Act. Tell me. Can you exempt this long-term gain which is there on immobile property by investing this long-term gain in notified bonds of NHAI which is redeemable after 5 years? Yes or no? Yes. This statement is true. The long-term gain can be exempted by investing in the bonds. But for that requirement is the investment in those bonds must happen within 6 months from 1st May 2025. And the amount of investment in those bonds should not be more than 50 lakhs. If it is more than 50 lakhs, any excess over and above that 50 lakhs will be ignored. Subject to these two conditions, the statement is correct. Hello, sir. Will you remember this? Sure, sir. Illustration number 12 is done. Now come to test your knowledge. Test your knowledge. In test your knowledge, question number 6. Okay. Now in this question, no. First you will have to calculate your capital gain of immobile property. And after you will calculate the capital gain of your immobile property, they are giving you the details of investment in notified bonds also. They are giving you the details of investment in residential properties also. Some residential property you have acquired outside India. Some residential property you have acquired in India. You have acquired the bonds also. And based on those investment, out of your long-term gain of residential property, how much long-term gain will be exempt under 54 and how much will be exempt under 54 EC. Whether you will be able to claim both the exemption? Yes. Because you are investing in residential properties also and you are investing in bonds also. First exemption you will take 54 or 54 EC. After claiming 54, whatever remains, that you can claim under 54 EC. Yes or no? So, but for that, first you'll have to calculate the capital gain. So I'm reading the question. Mrs. Yuvika bought a vacant land. Vacant land means piece of land. Okay, no? For rupees 80 lakhs in May 2005. So this is the date of acquisition and cost of acquisition of your land, which is an immobile property. Okay. Now registration and other expenses were 10% of the cost of land, meaning the cost of land, actual cost will not be 80 lakhs. 80 lakh plus 10%, 88 lakhs will be the actual cost of the land. That will be the cost of acquisition of this land. Okay, no? Now see, she constructed a residential building on the said land for 100 lakhs during the financial year 7-8. So second asset is there. Now second asset is building, and that building is a residential building which was constructed on this land. Now the land does not remain land, it becomes land and building. Understanding? So the long-term gain of this land and building can also be exempted under section 54. Understanding? So now she entered into an agreement for sale of the above said residential house with Mr. Johar, not a relative, in April 2015. April 2000 meaning on or after 1st April 2014. On or after 1st April 2014, she has entered into an agreement to sell the residential house to Mr. Johar. The sale consideration fixed was 700 lakhs. On 23rd July 2015, Mrs. Yuvika received 20 lakhs as what? Advance in cash by executing the agreement. However, due to failure on part of Mr. Johar, the said negotiation could not materialize and hence the said amount of advance was forfeited by Mrs. Yuvika. Simple. Advance money is received and forfeited. Prior to 1st April 14 or on or after 1st April 14. So in that year only, in the year 15-16 only, that would have been taxed under the head IFRS. No need to adjust this advance out of the cost. Hello? No need to adjust this advance out of the cost. So whenever you will sell the residential property, full cost of acquisition you are going to reduce without any adjustment of this advance money received and forfeited. Because this advance money received and forfeited is already taxed under the head IFRS as your income in the previous year 15-16. Done, sir? We have done few questions like this yesterday, guys. Okay. Mrs. Yuvika again entered into an agreement on 1st May 2015, 25. Can I say this is DOSA? Hello? This is date of sale agreement. For sale of this house at how much? Can I say this 810 is your sale consideration? She received how much? 80 lakhs as advance buy. So out of 810 sale consideration, she is receiving a consideration of 80 lakhs. Either the consideration or any part thereof is received by prescribed mode. And by the way, RTGS is a prescribed mode. Yes or no? Then whatever the stamp duty value as on the date of sale agreement is there will be considered for section 50C. Yes or no? The stamp duty value, what did I say? Stamp duty value on the date of agreement was how much? 890 lakhs. The sale deed was executed and registered on 14 July 2025 for the agreed consideration. However, the stamp valuation authority has revised the values and the value of the property for the stamp duty purpose was 900 lakhs, meaning the stamp duty value as on the date of registration. So can I say this 14 July is the DOR, date of registration? And on the date of registration, how much is the stamp duty value? So this stamp duty value is on the date of registration. And what is the stamp duty value as on the date of sale agreement? 890 lakhs. Now you have two stamp duty values. Which stamp duty value you are going to take? 890. Because as on the date of sale agreement, you have received the part of the consideration by way of prescribed mode. So 900 will be ignored. What will be taken? 890. Now compare 890 with 810. Is your sale consideration lower? Lower than your stamp duty value of 890? What is the difference? What is the difference? 80 lakhs. Is that 80 lakhs more than 10% of 810 lakhs? No. Because that 10% is 81 lakhs. And your difference is only 80 lakhs. So difference is not more than 10%. 50C will not apply. What will be the full value of consideration? Come on, tell me. Your full value of consideration will be 810 lakhs only. Your selling price. Because 50C could not be applicable. Because the difference was not more than 10%. But wait. The same question they will ask you in the exam. Here they will change the word RTGS to cross check. Same question they are asking you. Example, instead of RTGS, they'll write the word cross check. What are you going to do then? Then stamp duty value as on the date of sale agreement cannot be taken. Stamp duty value as on the date of registration, 900 will be taken. Now 900 and 810. Difference is 90. Is that difference more than 81 lakhs? Now full value of consideration will be 900 lakhs. Yes or no? So just changing one small information will change the entire answer. Exact same question they are going to give in the exam. People will start jumping. Oh my God, this question we have seen. The same question was there in ICS study mat. 2-3 times you might have solved this question also. Answer would have been printed in your mind. Now in the exam, you'll start solving the sum. All of a sudden you will get stuck at somewhere. You'll say, in that solution which I saw, it was 810. No, 100% it was 810. So in this, why my answer is coming 900? Some mistake is there. But still, I remember the answer. It was 810. So I will take 810. Gone. They know the student mentality. So they will play with you like this. Getting my point? Okay. Now see, subsequent to sale, Mrs. Yuvika made the following acquisition or investments. Acquired two residential house, Delhi and Chandigarh, for 130 and 50 lakhs respectively on these dates. So purchased within 2 years after the date of transfer of original property. Yes or no? And before the due date of filing ROI also. So both the houses are purchased within time. But investment in both the houses cannot be taken. Why? Because your capital gain here will be more than 2 crores. So since your capital gain is more than 2 crores, investment in any one house can be taken. So which house you would prefer, 130 lakhs or 50 lakhs? But if the capital gain was 2 crores or less, if the capital gain was 2 crores or less, then you could have taken both the investments. So will you get 54 exemption under section 54 based on this investment? Yes. Now we have acquired one residential house at UK. Very good. UK means Uttarakhand, no? Or United Kingdom. Outside India, you are purchasing this house. An investment in this house is made within time. But that investment will not qualify. So you have purchased 3 houses. Out of that, one is purchased outside India. So for that, 54, exemption under section 54 cannot be claimed. But exemption can be claimed for the houses purchased in India. But out of them, any one residential property, investment in one residential property will allow you to take the exemption under section 54. Yes or no? Next one. Subscribe to what? NHAI capital gain bond. Very good. Which is approved under section 54 EC. For how much? 50 lakhs on 30th November 25 and 40 lakhs on 9 January 26. So tell me, when did you transfer your old residential property? 1st May or 14th July? So from 14th of July 2025, you are supposed to count how many months? 6 months. Within this 6 months, the investment in bond should happen. So 14th July to August, September, October, November, December and January. Till 14th January 2026. The investment in bond should happen. So see, investment is in bonds on 30th November 25 and 9 January 26 is made within 6 months. Total investment is 50 plus 40. 90 lakh investment within that 6 months. But investment in bonds over and above 50 lakhs will be ignored. So total investment 90 or 50, whichever is lower, 50 lakhs. Or your capital gain, whichever is lower, that will be exempt under section 54 EC. So this will allow you to take exemption under section 54 EC. Now compute the income chargeable under the head capital gains. The choice of exemption must be in the manner most beneficial to the assessee. So here they are telling you that see, both the exemptions are coming, even we know. But the choice of exemption, first 54 EC, then 54, or first 54, then 54 EC, choice of exemption. Which one will you claim first? Must be in the most beneficial manner. Which is in the most beneficial manner? 54 first. And then section 54 EC. Yes or no? But for that, first we'll have to calculate the capital gain. Then out of that capital gain, first section 54, remaining, then that remaining under section 54 EC. Done, sir? I'm giving you 5 minutes. Crack the question. Do it fast. Do it fast, huh? Name of the assessee. Yuvika. Yuvika, no? Mrs. Yuvika. Help me solve this question. Mrs. Yuvika. Individual. ROR. PAN dash. Previous year 25-26. Assessment year 26-27. Computation of what? Capital gains. So first of all, full value of consideration. Selling price, how much? 810 lakhs, which is less than stamp duty value, which is 890 lakhs. Why have you taken 890 lakhs? Below the final answer, you are going to give one note. And that same note, we have written in one more question. Today only that question we have solved. That similar type of note you are going to give below the answer. Okay, no? Or you can show this calculation in your note also, working note also. So what is the difference? Difference is 80 lakhs, which is less than 10% of 810 lakhs. That is 81 lakhs. Therefore, 50C not applicable. And sale consideration is taken as what? Taken as full value of consideration. So here I am going to write down 810 lakhs. Got it, sir? Less what? Transfer expense. Any transfer expense is there? 1% brokerage. So 1% of 810 will be 8,10,000. How come 81 lakhs? 8 lakh 10 only, no? So your net consideration will be, tell me how much? 8 crore, 1 lakh. Okay. Less what? Cost of acquisition. Now you are not going to reduce the cost of building only, because residential property is constructed on the land. So when you will transfer the residential property, along with the transfer of residential property, land will also be transferred, no? Hello, sir. So cost of acquisition of land. Land was acquired in which year? Acquired in which year? 2005-06. What was the cost of that land? 80 lakhs? No, 88 lakhs. Yes. How did you get this? 80 lakhs plus 10% of 80 lakhs. 88 lakhs. Cost of land and cost of residential property. How much? 100 lakhs, no? Do the total. 188 lakhs. Reduce this. 13 lakh. This is your gross LTCG. This is so easy to calculate. I am telling you, so easy to calculate. less what? Exemption. Under section 54 EC, no? 54. Is it more beneficial? Very good. A. Amount of LTCG. This was how much? 6 crore 13 lakh 90,000. Or B. Investment in purchase of residential house property in Delhi or Chandigarh? Sure, Delhi. How much was that? 130, no? 1 crore 30 lakhs. Investment in purchase of only one residential property can qualify for exemption under section 54 EC. After this, whatever notes I'm going to dictate, no, those notes are very important. Okay. So, this or this, whichever is lower. What is lower? 1 crore 30 lakhs is lower, that much will be exempt. How much is remaining? 4 crore 83 lakhs 90,000. This is your balance LTCG. Now this balance LTCG, from this, can you take exemption under section 54 EC? Less. Exemption under section 54 EC. Again, A. Amount of LTCG. What was the amount of LTCG? 4 crore 83 lakh 90,000. Or B. Investment in NHAI bonds. How much is that investment? No. 40 lakhs, 50 lakhs plus 40 lakhs, no? 50 lakhs plus 40 lakhs is equal to 90 lakhs. That you have to restrict up to maximum. Maximum investment cannot be more than 50 lakhs. So 90 or 50, whichever is higher, no? Lower. Okay. So what is lower out of these two? So it will be 50 lakhs. So A or B, whichever is lower, tell me. How much will be the exemption under 54 EC? 50 lakhs. Understood? Calculate. 4 crore 33 lakh. Go and check the final answer. This is taxable LTCG under section 112. Question number 6, no? Same answer you are getting or some different answer? Same answer? Seriously? Ayyo, same answer. 433, 90. Yes or no? Now see, write down notes. First note. Note number 1, I am dictating. Please write fast. The stamp duty value, SDV, as on date of sale agreement, that is 1/5/2025, 1/5/2025, amounting to rupees 890 lakhs. 890 lakhs is considered for section 50C. because Yuvika has received part of the sale consideration by way of prescribed modes on or before this date of sale agreement. On or before this date of sale agreement. Full stop. Hence, stamp duty value as on date of registration, that is 14 July 25, amounting to rupees 900 lakhs, has been ignored. Has been ignored for the purpose of section 50C. First note. Done. Second note. Second note for what? What? Advance money received and forfeited. Write down. Second note. Advance money received and forfeited by Yuvika in April 2015. In April 2015. In the bracket write down, that is on or after, that is on or after what? 1st April 2014, bracket close, amounting to rupees 20 lakhs. Is ignored and not adjusted out of the cost of acquisition, under section 51 because it was already taxed under the head IFOS as income in the previous year 15-16 itself. In the previous year 15-16 itself. Full stop. Second note done. What other note? You are making 3 investment in properties. Out of that, why are you taking only Delhi? Out of 3, 1 is outside India, will not qualify. Other 2 are in India, but 2 cannot be claimed. Only 1 is allowed because the amount of capital gain is more than 2 crores. Hence we have taken only Delhi, which is more as compared to Chandigarh. Yes or no? This we have to write in the form of note. Write down. For the purpose of claiming exemption under section 54, for the purpose of claiming exemption under section 54, why are you not writing? Huh? Now come to garden or what? For the purpose of claiming exemption under section 54, the assessee should invest in any one residential house property in India. The assessee should invest in any one residential house property in India. In the bracket write down where the amount of LTCG where the amount of LTCG on transfer of old RHP is more than 2 crores. Close the bracket. Full stop. Paragraph. Hence, rupees 180 lakhs invested in purchase of property at UK, has been ignored. UK, besides that, in the bracket you can write down outside India, okay, no? Or and next line, and investment in purchase of properties, in purchase of RHPs in Delhi and Chandigarh are eligible. Out of which what have you written? Out of which investment in RHP at Delhi is only considered. Investment in RHP at Delhi only is considered since it was higher. Full stop. Done, sir? So these 3 notes should come in your answer. Otherwise you will lose marks. Done, sir? So this is the end of your this is the end of your question number 6. Now do you remember question number 3 also we have solved? Test your knowledge. And half part of that question is remaining. That half part I told you that we are going to solve after doing 54 EC. See, listen, you had one stocking trade. You had one capital asset which you converted into stocking trade. That capital asset was an immobile property, land. So land was converted into stocking trade. And now the land is sold as stocking trade in the year 25-26. So when the capital gain of the land will be taxable? In the year of conversion or in the year of sale of stocking trade? So you have calculated the capital gain of the land in that question. How much was that capital gain? 68 or 67 lakh something. Yes or no? So if you can see, I have solved that question over here. I will show you that question solution. Harshita, no? Harshita? This is the answer which we solved. If you can see. Yes or no? What was the capital gain? Tell me. 68,14,159. This capital gain will be taxable in which year? In the year in which the stock in trade is sold. Now out of this capital gain, if you want to claim the exemption, can you claim 54 EC exemption? Yes, because this is the capital gain of immobile property. So capital gain of immobile property, from that capital gain you can claim the exemption provided you invest in notified bonds within 6 months. Within 6 months from the date of conversion or date of sale of stock in trade. So when did you sell the stock in trade? March 2026. You constructed 15 flats in February 26. Out of those 15 flats, 10 flats you sold on March 2026. Yes or no? So you have sold your land along with the flats as a stock in trade on what date? March 2026. So within 6 months from March 26, you have to invest in bonds. So now see, second part of the question says that you have invested in bonds. Yes or no? So let's come to the second part. They are saying that Harshita invested 50 lakhs in the bonds issued by NHAI on what? 31st March. Oh, within 6 months, 50 lakh investment is done in bonds in the month of March itself. Yes or no? And 50 lakhs in the bonds of RECL in April. Within 6 months, this investment is also made. So this entire investment is how much? 100 lakhs. 100 lakh investment in bonds will not qualify. Maximum investment is 50 lakhs. So out of this capital gain which you are having right now, how much? 68 lakh 14,159. So the long-term gain, the long-term capital gain under section under section 45(2) you have calculated, no? Under section 45(2) for land, which was taxable in previous year 25-26, was how much? 68 lakhs 14,159. Out of this, I'll claim the exemption. Exemption under section 54 EC. How much exemption, guys? A. The amount of your long-term capital gains, which is 68 lakh 14,159, or B. Investment in bonds of NHAI and RECL. Both the bonds you are purchasing within 6 months. 50 lakhs plus 50 lakhs is equal to 1 crore. But this investment cannot be more than 50 lakhs. So maximum investment allowed is 50 lakhs. So 1 crore or 50 lakhs, whichever is lower. How much is lower? 50 lakhs. So out of that 50 lakhs will qualify. 50 lakh or 68 lakh 14,159, whichever is lower. So how much will be exempt? 50 lakhs will be exempt. So out of 68 lakh 14,159, 50 lakh will be exempt. So how much will be taxable? 18 lakh 14,159 will be your taxable LTCG under section 112. Check the final answer of that question. Go. Same answer you are getting. 18 lakh 14,159. If you know now why I left that second part of the question, because we did not do 54 EC. Now 54 EC, after 54 EC, see how easy that question is. So that same question can be asked in the exam. That Harshita question is that is also important question. All the questions in test your knowledge sections are there, no? Don't leave a single question before exam, I'm telling you. You can see any one question in the exam out of all those questions. Because out of all those questions, 3-4 questions are new questions, newly inserted in your ICS study mat. Okay? Should we move ahead? So that remaining one question, the balance part is also done. So we are through with all the questions of test your knowledge. Through with all the questions of test your knowledge. Now come to the illustration. Last illustration is pending. Illustration number 13. Mark this question also important. I've already told you to mark this important. Okay? See now. Very, very, very easy. Very easy. And this was a question, a similar type of question came in the exam also for 8 to 10 marks. Okay? 4 different cases are there. 4 assessees are there. Mr. A, B, C and D. Now tell me, what is the age of Mr. A? Is he a senior citizen? So basic exemption limit available for him will be 2,50,000. Mr. B, age is 62. But he is not a senior citizen. Even if he is 60 years or more, he is not a senior citizen. Why? Because he is a non-resident. And non-resident can never be a senior citizen. Okay, no? So for him also the basic exemption limit will be 2,50,000. Yes or no? So exercise the option of shifting out. See here, option 2, shift out. Okay, no? Meaning, is he following 115 BSc? Not following 115 BSc. All the assessees are not following 115 BSc. So here, he is not a senior citizen. Here also, even if the age is more than 60, he is not a senior citizen because he is not a resident. Here the age is less than 60 and also he is a non-resident. Hence we are not treating him a senior citizen. Mr. C is a senior citizen. Yes, because he is a resident. And sir, his age is 81. So he is not a senior citizen. He is a super senior citizen, sir. And Mr. D, whose age is more than 80, he will not be treated as a super senior citizen because he is. Yes or no? Now see. First case, second case and last case. The basic exemption limit will be 2,50,000. Third case, Mr. C, the basic exemption limit will be 3 lakhs. Understanding? Okay. Now, all of them are earning total income. Total income other than LTCG. So, this is the normal total income taxable at what rates? Normal rates. So, 2,40,000, 4,10,000, 5,90,000 and 4,80,000. Now tell me on this normal income, what rate will be applicable? Normal rates. At normal rates, this income will be taxable. And to pay tax on the long-term capital gain, if nothing is mentioned, the long-term gain will be covered by 112. And if STT paid long-term gains are there, they will be covered by 112A. So you have to check that which asset is getting transferred. Long-term gain on transfer of vacant site. Vacant site means land. So you are selling the land and long-term gain is there. How much long-term gain? 85,000. This long-term gain will be covered by 112A or 112. So here 112 tax rate will be applicable, which is how much? 12.5%. Okay, no? Now see, long-term gain of 10,000 on transfer of listed equity shares, STT paid on sale as well as purchase of shares. Can I say this long-term gain will be covered by 112A? And 60,000 from sale of agricultural land in a rural area. Sir, you are transferring land, so this long-term gain will be covered by 112. Wrong. Because you are transferring rural agricultural land, which is not a capital asset only, its gain will not be taxable only. So applying 112 will be a suicide. Understanding? Next one. Last case, no long-term gain is there. Now in all the cases, you have long-term gain, normal income, long-term gain, normal income. Yes or no? So in all the cases, you are supposed to calculate what? Tax. Calculate the income tax liability in all the cases. Very easy, huh? Very easy. First, let us calculate for Mr. A. Okay, let us calculate for Mr. A. So, first talk about Mr. A. Mr. A. Mr. A. Who is a non-resident plus age is 45 years. Okay. So for Mr. A, first of all, which income? Normal income. Normal income is how much? 2,40,000. Yes or no? And he has a long-term capital gain which is covered by section 112 amounting to 85,000. Yes or no? Calculate his total income. So his total income will be 3,25,000. Now on this total income, if we have to calculate the tax, so tax on LTCG under section 112. Okay, LTCG was 85,000. 85,000. Yes or no? On this entire 85,000, the tax will be calculated. Sir, even if his balance income, do one thing. Wait. If you have to calculate the tax, no, you will be understanding this thing in more better way if you do it like this. Split into two part. What is the long term gain? LTCG under section 112 is equal to 85,000. On that you have to pay 12.5%. And the balance total income is how much? Balance total income is 2,40,000. Yes or no? What is the basic exemption limit applicable to this SSE? 2,50,000. Yes or no? Now, if you reduce this basic exemption limit, can I say you still have some unexhausted basic exemption limit? How much? Can you adjust this against this income? The answer is yes, you can. But it is available only in the case of resident individual and HUF. And he is a non-resident. So this adjustment, what did I say? This adjustment out of your LTCG is not possible since he is a non-resident. Yes or no? So on this entire long-term gain, the tax will be calculated at the rate of 12.5% on 85,000. Calculate. 10,625. So this is the tax on his long-term gain. And can I say on this income the tax will be nil because this entire 2,40,000 is covered by the basic exemption limit. So there is no tax on this income. Understanding? Now therefore tax on total income is how much? 10,625 plus nil is equal to 10,625. Now pay attention, a very important thing I am telling you, very important thing. If you see his total income is less than 5 lakhs. So when your total income is less than 5 lakh, out of your tax you get what? Rebate also. But that rebate cannot be given to a non-resident. So even if the total income is less than 5 lakhs, rebate will not be available. Add what? Add health and education cess at the rate of 4%. What is 4% of this? How much? 425. Do the total. 11,050. This is the tax liability of Mr. A. And in the note you are going to write down what? Rebate under section 87A not available since Mr. A is what? Non-resident. Even if his total income is less than what? 5 lakhs. Got it, sir? Like this you have to calculate for Mr. B. Wait. This you have calculated as if Mr. A is not following 115 BSE. If he is not following 115 BSE, then you have calculated this. What if he was following 115 BSE? Let's see. If he was following 115 BSE, let's see. What I will do? Copy paste, no? Best thing I can do is copy paste. So this is Mr. A. Now instead of 115 BSE, cross mark. What should I write? 115 BSE, tick mark. He is following 115 BSE. Everything will remain same. Total income will remain same. Now see here, instead of basic exemption limit, how much? For 2,50,000, I will write down, because under 115 BSE, basic exemption limit is 4 lakhs. So how much is unexhausted? 1,60,000. That 1,60,000 also I cannot adjust, no? Because adjustment is possible only if the assessee is resident. But since he is a non-resident, this adjustment is not possible also. Yes or no? So here the tax will be on 85,000, the same amount. And the tax on your normal income at 115 BSE rates will be nil. So what will be the tax? 10,625. And see, even if your total income is up to 12 lakhs. Now you will say 12 lakhs because you are following 115 BSE. So in 115 BSE you get rebate if your total income is up to 12 lakhs. So is your total income is up to 12 lakhs? Yes. Still you cannot claim rebate because rebate is available only to. So your answer will be same. Your answer will be same. So here what should I write? Less than equal to 12 lakhs. Since Mr. A is non-resident, rebate under 87A is not available. So Mr. A, following 115 BSE, not following 115 BSE, the tax liability will be 11,050. Everyone got this? Everyone got this? Now we are going to discuss about Mr. B. Tell me, Mr. B is a non-resident and his age is 62 years. So is he a senior citizen or not a senior citizen? Rebate also he will not get, and adjustment of unexhausted basic exemption limit will not happen in his case also. So 115 BAC not followed. Okay. So tell me, what was his normal income? Normal income is equal to 4,10,000 and LTCG he is having under section 112A. That amount is 10,000. So what is his total income? His total income is 4,20,000, which is less than 5 lakhs, less than 12 lakhs. Still he will not get any rebate. Understanding? So on this total income, split this total income into two parts. From this total income, LTCG under section 112A was how much? 10,000. On this, will he pay any tax? No. Tax will be nil because LTCG 112A up to 1,25,000, the tax is nil. Balance total income how much? 4,10,000. On this, will you apply normal rates? Yes, because you are not following 115 BSE. So on this, the tax will be nil for the first 2,50,000. Yes or no? Nil for the first 2,50,000. Then 2,50,000 to 4,10,000 on 1,60,000. How much tax? 5%. You remember no tax rates? Hello? So 2,50,000 to 4,10,000. How much? 2,50,000 to 4,10,000. 2,50,000 to 4,10,000. How much is the difference? 1,60,000 on that 5%. 8,000. So here your final tax will be 8,000 plus nil. So therefore, tax on total income is equal to nil plus 8,000 will be 8,000. On this tax, will you get any rebate from here? Sir, my total income is below 5 lakhs. Still you are not going to get any rebate. Why? Because you are a non-resident. Even if your total income is up to 5 lakhs, still you cannot claim rebate. So add what? Health and education says H and EC. At what rate? 4% of 8,000 will be 320. So 8,320 will be your tax liability. Everyone understood this much? Now, if he is following 115 BSE, then copy paste. Simple thing, copy paste. If Mr. B is following 115 BSE, tick mark. Any difference in total income? No. LTCG tax will be nil. But balance total income Now first 4 lakhs, because now the basic exemption limit will be 4 lakhs. On the first 4 lakhs, the tax will be nil. And 4 lakh to 4 lakh 10,000. On the 10,000, 5%. 500. Yes or no? This will change. So the tax liability will be nil plus 500 will be 500. Getting my point? On this 500, 4% will be 20. So final tax liability will be 520. You got this or not? Easy, difficult? Easy, no? Just imagine these kind of small thing, case scenarios they will ask in the exam. 4 options, choose the correct option. Now, who is the assessee? Mr. C. His status is resident. Be very careful, huh? And the age is 81 years. So he is a super senior citizen, guys. Okay. So tell me, what is his normal income? Normal income is 5,90,000. What is his long-term capital gain? Nil. Why nil? Because that long-term capital gain is on transfer of rural agricultural land, not taxable. It is treated as agriculture income, fully exempt. Do you remember that? So now this long-term gain is there, and total income is how much? Total income is 5,90,000. And we are solving the question assuming that he is following, wait, huh? B, this was Mr. A, no? Huh. We are following 115 BSc, not following? Not following 115 BSc. So if not following 115 BSc, tell me, out of this, can I say on the entire total income I can apply the normal rates now? Because no income is a special income. So I will directly calculate tax. Tax will be on the first 5 lakhs, no tax. Because for a super senior citizen, the basic exemption limit is 5 lakhs. Do you remember that? And 5 lakh to 5 lakh, 90. On the 90,000, he will pay 20%, meaning 18,000. So the tax will be 18,000. And will he get any rebate? No, because his total income is more than 5 lakhs. Yes or no? So no rebate. Add what? Health and education cess at the rate of 4%. How much? How much? 720. Add 18,720. This is your final tax liability. Getting my point? Now if he follows 115 BSc, then same thing, no? Same thing, copy paste. Copy paste. What if he follows 115 BSc? Tell me. So now the total income will remain same. Tax liability will not be 18,000. Wait, huh? Guys, first 4 lakhs. Because the basic exemption limit now will be 4 lakhs. First 4 lakhs, no tax. 4 lakh to 5 lakh, 90. On 1 lakh 90, how much? 5%. How much? 9,500. So the tax will be 9,500. And now guys, minus what? Rebate also. Rebate under section 87A. Why rebate? Because now his total income is below 12 lakhs. Yes or no? So whatever tax is there, 9,500 or maximum rebate is 60,000. Whichever is lower, 9,500 will be rebate. So how much is the tax payable? What is the final tax liability? Nil. In that, if you add 4%, it will be nil. Try it once. Understanding? Last case. Last case is Mr. D, no? Now you calculate for Mr. D. Come on. D, non-resident, age 82 years, not a senior citizen, not a senior citizen. What are you going to do then? Take the normal income. How much is the normal income? Normal income is 4,80,000. Any long-term gain? No, nil. So total income is 4,80,000. On 4,80,000, will you calculate tax? Yes, directly apply the normal rates. Now the basic exemption limit will not be 5 lakhs. Basic exemption limit will be 2,50,000. So first 2,50,000, no tax, 2,50,000 to 4,80,000. On 2,30,000, the tax will be 5%. So 5% of 2,30,000 will be 11,500. Add 4% cess. No rebate. Why? Because the assessee is a non-resident. Got it, sir? So 4% of that. Add 4% and the final income will be, final tax will be 11,960. Are you getting 11,960 everyone? And if 115 BSE is followed, 115 BSE is followed, then first 4 lakhs, no tax. Then 80,000, 5%. On 80,000, 5% will be 4,000. No rebate, even if the total income is below 12 lakh, because the assessee is a non-resident. Yes or no? So calculate 4% of 4,000. 4% of 4,000 will be 160, 4160. See, 4160, final answer. Okay. So this brings to an end the chapter capital gains. Finally over. All the questions we have completed. Okay. Yesterday I have sent you question bank. You received that? Please solve all the questions, huh? Okay. So we'll take a break now. And after the break, we are going to start with income from other sources. Okay. See you after the break.